Hello, everybody. This is Toni Turner, and welcome to the market now as of Friday, April 29th at about 1:30 p.m. Eastern. Well, at the moment, the S&P 500 is down nearly 2%, while the NASDAQ trades lower by 2.1%. Been quite a day. The NASDAQ, of course, is underperforming because of weakness in Amazon. Apple and Intel all down following their earnings reports and down quite a bit. Tesla is up slightly, providing offsetting support. Even the energy sector is trading lower despite the increase in oil prices. Chevron and ExxonMobil are holding back the sector after both missed earnings per share estimates. And on all that cheerful news, we will go on and look at three charts that could give us some insight into the week to come. As we always do, we're first going to look at a daily chart of the S&P 500 SPDR, symbol SPY. This is the ETF that closely follows our benchmark S&P 500 index. Now, you might want to say, hey, why do we have to know where the S&P 500 is? I mean, I know it's the benchmark, but why do we have to follow it? We do that because as traders, we're tops-down kind of approach, kind of strategy to the market, meaning we look at the overall picture first, and then we funnel down to the stock or ETF that we're looking at. So please know that when the market is moving higher, when it's bullish, 3 out of 5 stocks will follow the S&P 500 higher. In a bear market or a downturn like we're having right now, 4 out of 5 stocks will follow the S&P 500 lower. So think of it as a crystal ball, if you will, kind of this is the direction, this is the mood and manner of the market right now. And please know that while it does not affect every single stock, the SPY certainly affects the majority of stocks and the direction they go in. So let's look at this daily chart today. When I captured this chart, the SPY over here was trading at $418.95. That's about $41.89 in the S&P 500 itself. Now, that is about 13% below the SPY's last all-time closing high, which was on January 3rd at $477.71. Now, of course, we've done this before. We know that from that January high, the SPY rolled over and came down pretty dramatically. We had a bounce up here, but it moved down dramatically, moved up, and then fell to this low here. This is February 24th, and nearly everything in the market fell on this day, fell down, and then gapped open. When it fell to this low, a lot of buying went on. That was in small caps, tech stocks, momentum stocks, value stocks. This February 24th was quite a dramatic day. And so the SPY gapped down on that day, of course, and it gapped down to open at $410.64. Then it moved up dramatically. The short sellers got caught in a squeeze, and the SPY moved back up to the red line, the 20-day moving average, back up here up to 441 toward the end of February. Then it rolled over to retrace back down, not quite to that low, not quite to that 410 low, but this time it stopped at about 415. And it consolidated here, meaning it found support here, meaning buyers came in and bought whenever it headed back down to this 415 low. Buyers came in and bought. So it did not move all the way back down to the 410 low that we saw at the gap on February 24th. So that was a good thing. That was a positive thing. We always want to see higher lows, meaning buyers come in and buy before the stock or index can get all the way back down to its low that we're talking about here. Then price moved up from these lows at 415 in March, started moving up and moved up pretty dramatically here. Very steep angle moving up. Sometimes I have to sigh and roll my eyes because I know what that means. Usually angles like this are not sustainable for long periods of time. But at any rate, it was a nice move. It was bullish. So the SPY moved through the 20-day, through the green line, which is the 50-day moving average, through the 200-day moving average, which can be a pretty heavy resistance line when price is underneath it. But the SPY moved right up above it and up to 462 on March 29th. But that steep move here kind of made me, at least for the short term, hold my breath. And sure enough, the market rolled over, came back down through its 200-day moving average, hesitated in here at about 444 or so, consolidated, and then jumped up to the 200-day again at now coming in at 448, and then fell as it has for the last week and change of trading days, fallen very dramatically. So now we're down again today at 418, just above this very, very important support line at 415. So, and I'm going to say here we are again, because a year ago, guess what? The SPY was trading last May in 2021. The SPY was trading at 415. So we've had a heck of a year. It was a whole lot of fun in the beginning and not quite so much fun here as we rolled into, again, after we made these January highs and then started one very exciting roller coaster ride that we've had from January on this year. So what we have here for nearby resistance, we have right here at 430. So if price starts up from here, if the S&P starts up from here, it may have some resistance at 430, and we can find that resistance again at these prices here. It was resistance. Now, what was resistance was once support. At one time, 430 was support for this price action here. Then price rolled below it, and it became resistance. Then it moved back up again, then 430 support again. You see how this works. So we're back down now where 430 is resistance again, because we're back under it. And we're looking at 430 here, and then we can see that at 437, where the 50-day moving average comes in, we have more potential resistance and on up. What we do as we move through the next week of earnings announcements, and this has been part of certainly part of the reason for the market's fall, as we move through more earnings season and, of course, facing the Fed potentially raising interest rates. Right now, it's important that the SPY holds this 415 support line to stay bullish. It is very important. We have a little support here at 410, but certainly more at 415. So please know that if 415 breaks and price starts down, we could possibly, not absolutely, but possibly see another leg down. So I'm kind of standing a little bit on the sidelines here, and as they say, keeping my powder dry. Our next chart today is a chart of the Invesco QQQ, symbol QQQ. This particular ETF represents the NASDAQ 100, and they've had quite a ride today. As you know, Apple, Amazon, Intel, the stocks that we talked about before, they're all in the NASDAQ 100, the QQQ, and it's been quite a ride in the last couple of weeks, actually since the middle of March. So right now, as I captured this chart, the QQQ was trading at $319.50. This is in bear territory now. This price here today is about 21% below the all-time closing high, which we saw on November 19th at 403. Whenever you're more than 20% below the last all-time high, is considered to be in bear territory. Now, this is no reason to panic. For a lot of people, it's going to be bottom fishing, and we'll look at a bottom fishing potential trade today in just a minute. However, we do need to know here that this 318 line here is extremely important. From mid-January, the QQQ rolled over. It moved in a downtrend, lower highs, lower lows. On February 24th, that very famous day for all, it seems like for the whole market, the QQQ gap down to $318.26. It certainly, it's moved very much quicker up from there. And as we can see, and made a similar pattern to the SPY, it moved up from there. Actually, back up to the 20-day moving average, back up to 350 here, then rolled over to retest back down to their lows here, did a real quick move down to retest all the way down to the lows, not making a higher high, which would have been a higher low, which would have been bullish, but back down here to these prior lows. Anyway, it held there. That's a good thing. Then, like the SPY, made a very dramatic, steep move up, back up to 369 up here, right at just over the 200-day moving average. Rallied up to there, then cratered and did a dumpster dive back down here to the lows that we're looking at today, currently trading at $319.50. So now we have 1, 2, 3 points here and a slight consolidation. At these lows, 318, 319, very important level here. And once again, just like the SPY, we're back to where we were in May of 2021. So we've been there, we've done that, and it's been quite a ride. We need to hold here at 318 for the NASDAQ 100, or it could potentially take another leg lower. So we need to be conservative, think through our trades, and definitely put stops in if we go long or short on anything. Our final chart today is a daily chart of the Invesco Solar ETF, the TAN, kind of staying out of tech stocks and the broader market here. I know there will be opportunities. I don't know that this is the day to get in. So I'm looking at the Invesco Solar ETF. It is definitely public companies. It is stocks, but it's not in the typical norm of things. Invesco Solar ETF has international holdings. Top holdings include Enphase, SolarEdge, First Solar, and Sunrun. Now, it made a recent highs back here in 2021 in October, November. In October 21st, it made a high at $101 right here and 58 cents. Then it rolled over pretty hard, as you can see. I suspect this may have had something to do with the Ukraine. At any way, the TAN, rolled over and went into a very solid downtrend. You can see how the 20-day moving average acted as a channel line overhead. It went down to the lows here and consolidated up around 60, then fell down on February 24th with everybody else to $56.08. Now it jumped up from there, rallied up, started up through the 20-day, the 50-day, consolidated, finally moved up to the 200-day moving average. But note how the 200-day moving average held it down here, especially if the 200-day moving average is moving at an angle lower. It can provide pretty steep, pretty strong resistance. And it did so here on the TAN. So it ran up to the 200-day moving average to $80.52. Then it started back down, dropping below the 20-day, finally the 50-day, to where it is now. Today, when I captured this chart, the TAN was trading at $65.20. Now, okay, please listen up. I'm going to consider this as a bottom fishing play. And because it's a bottom fishing play, it is going to be, I have very definite limits on this because I am not in the mood to lose any money in the stock market. Certainly not very much. So I'm going to consider this a bottom fishing play, and my stop will be a hard stop placed with my broker. So that means to me, right after you enter and confirm that your order, if you place an order to go long, the TAN, if you choose to do that, make sure, of course, as you always do, you place your order with the broker, make sure it goes through. Right after that, I am going to place a protective stop with my broker right then and there. And so I will not have the chance to go in and say, oh, well, it went through my stop, but if it's a mental stop, sometimes you say, well, it went through my stop, but it's okay because it's a good company or a good ETF and it'll come back. I am not going to have that kind of tolerance or that kind of strategy thinking for any bottom plays, absolutely, especially in this particular market. So this is what I'm going to do. In the coming week, if the TAN can remain above 60, and right now it's trading at $65.20, I will buy. I'm going to give it a day or two, see how it goes. I will buy a small position and then in my trading account, and I will place a hard stop with my broker right after I place the buy order. Once that's confirmed, I'm going to put a hard stop with my broker placed at $59. If and when the TAN can climb up through the 50-day moving average back up to over this line, it's going to be at about 73. I'm going to wait. You don't have to, but I'm going to wait. I will add to my position if and when the TAN can climb and close above the 200-day moving average. And of course, by then I will have had moved my stop with my broker as a trailing stop. Okay, trailing stops can be set as percentages or dollar amounts. You can do either or just a flat price amount, as we did when we placed our stop at 59. So you can choose any of those, but again, in this market, I'm not in the mood to take unneeded losses, so I'm going to keep my discipline very strong. So you may, it looks like the TAN could come back here. You may want to keep an eye on the TAN in the coming week. Now, please know that this is the perfect time to invest in yourself. Take a few minutes to check out my online training programs and see how you can become a better trader. These programs include our flagship training, 7 Steps to Successful Trading, how to swing trades successfully, how to trade the trend to profits, plus really good for beginners, how to read charts, 3 winning setups, and another one that I like right now a lot, how to bottom fish like a pro. This is the perfect time to learn that. These programs are timeless, they're low priced, and they can help you increase your gains quickly and easily. To see all of my online training programs, simply go to the link on the screen or simply click on the orange button below. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.